Christy learns about P/E, P/B and other financial ratios. So, what would you like to have?
I would like a cup of coffee.
I'll just order and come. Christy places the order.
So, how is your stock selection going?
Pretty good. Can you tell me what is P ratio?
PE ratio stands for price to earnings ratio. It tells about the amount earned by an investor for each block of earning. Also, it tells us whether the stock is undervalued or overvalued. One can know the ideal PE ratio by comparing current ratio with historical ratio. If the current ratio is less than the historical ratio, then the stock is undervalued, and vice versa. However, it has its own demerits. For example, IT companies have more PE than the manufacturing companies. But, this does not mean that the manufacturing company is available at a cheap valuation. So, PE ratio is helpful only when the comparison consists of stocks of same sector.
What is PB ratio?
PB ratio means the ratio between price and book value of a stock.
What is book value of a stock?
Book value refers to the remaining capital left with the company after it pays all its debt by liquidating its assets. If the current PB ratio of a stock is less than the historical PB ratio, then this implies that the stock is available at a cheaper valuation. And similarly, when the current PB ratio is more than the historical PB, then this implies the stock is available at a costly valuation. Irrespective of the theoretical limitations of PB ratio, researchers have shown that stocks with low PB ratio have done better than the ones with high PB ratio.
What is debt to equity ratio?
Debt to equity ratio tells about the debt involved in the business with regard to the promoter's capital. A very low value of this ratio is a very good signal to buy a stock. But it is not that easy. Automobiles and manufacturing companies have a high debt to equity ratio because of the large capital required. So, it is very important to take all factors into consideration.
What is operating profit margin?
Operating profit margin is calculated by dividing operating profit by net sales. It shows functional efficiency and pricing power. A higher value of this ratio shows effectiveness in obtaining raw materials and converting them into final goods. It measures the proportion of revenue that is left after meeting variable costs, such as raw materials and wages. The more is the margin, the better it is for the investors. While analyzing a company, an investor must check for an increase in the value of operating profit margin over a period of time. As a company is a collection of projects, therefore a profitable project will add something to the company. All the projects are not of same size, so, to adjust this size discrepancy, the profit is divided by sales revenue. As a result, this ratio helps in analyzing the contribution of projects to a company. This ratio is very much effective when a company loses or bags a new project.
What is? Chris gets a phone call.
Sorry, got an important call. We'll have to leave. See you later.
No problem, bye. For more information visit ProTrading.